What happens when interest rates triple, at least double, and refinancing isn't an option? It's very simple. Distress, panic sales, steep discounts. But for savvy investors, this isn't a crisis, it's an opportunity. Stick around and I'll show you how to capitalize on distressed multifamily properties in 2025. And even if they're not distressed, at least finding better deals than before because people are stuck in a bad situation. Now keep in mind, this doesn't mean that every property out there is going through trouble. But what happens is you buy a property, you get a low short-term fixed rate, and then rates suddenly skyrocket. This is especially prevalent with developers. What they do is they build properties on construction loans, and construction loans float. But when you see rates go from 0% to 5.25 in a matter of 15 months, that can take your rate from 3 or 4% up to 7, 8, 9%, which can take your project from massively profitable to absolutely a train wreck and having to turn it over. The majority of deals I'm finding right now are because a developer overextended themselves and it's causing cross-collateral damage across other properties. What I mean by that is they might have put a performing loan up as collateral for their pre-construction loan. But when the construction loan goes bad, it makes the bank call out on the performing loan. So here's the example. Consider a 20-unit apartment complex that might have seemed a little bit too expensive back in 2021 because the cap rate was low. What drives that cap rate? Interest rates. So the lower an interest rate, the lower a cap rate can go. What's the cap rate? It's essentially the return you're making if you pay cash for the property. The lower the cap rate, the higher the price, because the lower return, the higher the price. Now today, as interest rates have risen since those times, that has caused values to fall if people were not keeping up with the rent increases. That same property might be available at a very nice discount, making it a great deal for savvy investors. So let's start by understanding the core challenge facing multifamily investors right now. I've said it over and over, rising interest rates and expiring loans. So back in 2021, bridge loan rates were around 6 or 7%, and investors could easily secure favorable terms. But here we are in 2025. Rates have gone up to as 9 or even 11%, making refinancing far more difficult. The higher the rate, the more profit the property needs to make to justify that high rate. And you got to remember, even though rents have increased by 25 or 40% in some markets since January of 2020, it can take time for those increases to fully offset higher debt payments. And with those rents being higher, your expenses are way higher because you got to pay higher wages because wages are up a ton in the last 5 years. This means that while some investors are managing cash flow better than others, many still face significant pressure, especially if their rents have not caught up. Because remember, a lot of landlords just want to keep a property full. So they'll keep their rents lower. But when their expenses go up and they're keeping their rents low, it takes a while for them to get their renters out or increase their rental rates to make up for their higher expenses. And everyone in this world believes that the landlord is so rich, they don't care that person might be in trouble. And I don't blame them. So as they're building these properties and leasing them up, these bridge loans usually last about 3 years, and they're usually floating. So even if they don't float and they locked in, those loans from 2021 are maturing. And without these favorable refinancing options, many owners may be forced to sell at a steep discount. Now, for smart investors ready to move fast, this isn't just a market shift. It's a rare window of opportunity. In every crisis, there's those who wait and those who act. Golden opportunities like these don't last for long. Back in 2009, 2010, there was that short window of being able to go in, buy properties, and we were buying properties almost sight unseen. As long as the basements weren't caving in, we were buying them. And we made a crap load of money. My best deal was in December of 2009. Actually, the last day of the year, I closed on a 300-unit property in Ohio for $3 million, $10,000 a door. Today, that property is valued at $24 or $25 million. I've put in $6 or $7 million into it. But still, even with that, the profit is insane. Now, it's very important as a real estate investor that you understand a term called DSCR, debt service coverage ratio. This is especially important because we're covering interest rates. What it does is it takes your debt service. Let's say your mortgage, just your interest principal payments are, let's say, $2,000 a month. What they want is a premium to that. A lot of times it's 1.25. So they want to make sure your property generates $2,500 a month. Well, if all of a sudden your rate and your principal makes your payment go to $3,000 a month, the same debt service coverage ratio, you have to make $3,750. That's a 50% increase, guys, because your mortgage payment went up 50%. This can make or break your refinancing options. Imagine you go to a bank and say, hey, I'm making $2,500 a month. Well, they're like, yeah, but now your mortgage payment's gonna be $3,000. We need you to make $3,750 a month. What do then? Do you have the cash lying around to go pay down that debt to make sure that this payment becomes $2,000 again? Most landlords don't. Most landlords are wealthy, but on paper, not in cash. Think of the debt service coverage ratio as kind of like the heartbeat for the property. It shows whether the income is strong enough to keep the property alive by covering its debt. For investors, you want to know this because it tells you whether your property can generate enough income to cover debt payments. A DSCR above 1.25 for most banks signals healthy cash flow. But if it drops below 1, not only do you risk having a bank call your loan, but you also have that risk of not being able to refinance unless you come to the table with a huge check to make the debt service coverage ratio the proper ratio. Now, obviously, as you've shown here, as rates increase, your payment goes up. And that crushes your ability to cover that debt service coverage ratio. Now, guys, I want everybody to remember, bankers don't give a flying f about you. They'll sit there and talk about how they're your teammate and they're your partner. They don't give an F. I saw this happen time and time again from 2008 to 2011. Some good people who always paid their bills losing properties. They don't care because guess what? That same banker who loves you a ton and says he'll be there for you, if it came to his job or you, who's he going to pick? So if you don't have the cash to inject into the property to make that mortgage a lot lower, the only other option is selling under pressure. And guys, when you sell under pressure, you make a lot of money. As Warren Buffett says, when I get phone calls on Sundays, I make a lot of money. And the reason for that is if somebody's calling me on a Sunday for a deal, it means they need money. And when they need money, he gets really, really great terms. Now, earlier I talked about cap rates. Now, guys, again, what's a cap rate? If a property is worth $1 million and it makes $70,000 per year, the cap rate is $70,000 divided by 1 million, or 7%. If you paid cash for the property, you're going to make a 7% cash return. Now, as cap rates go down, if it's 3%, that $1 million property makes $30,000 a year. But the same thing we can do here. If it makes $70,000 a year and you want a 3% cap rate, you just do the math again. And what this is basically $2.2 million. So, cap rates, as they go down, prices go up. As they go up, prices go down. They work inversely. But remember, as interest rates go up, that cap rate has to go up along with it. Because if you're being charged 5%, you can't pay a 4% cap rate on a property unless that has major growth potential in rent because of renovations and things like that. I have paid 3 and 4 caps for properties that were the best deal ever. I paid essentially what I thought was a 3% cap rate. And guess what? I made 40% returns because the rents were too low. But if you're buying a stabilized property without that upside potential, it's hard to pay an interest rate higher than your cap rate and expect to do well. During the hot markets of 2021, cap rates for multifamily properties were around 4%, meaning investors paid a premium for cash flowing properties, but they were borrowing at 3 to 3.5%, so it could make sense. Obviously, we disagreed, saying, are rates going to stay this low forever? Nowadays, cap rates are at 5.5%, 6% on top tier property, meaning those same properties, if they have the same income, are worth a lot less money. Now, if they've been able to raise their rents 40%, they're fine. In fact, they're probably doing above average. We've had that happen with our properties. Back in 2021, I saw those properties with low cap rates that seemed overpriced, so I held back. Now, in hindsight, I wish I'd bought them because I would have greatly increased rents, but most landlords don't want to do that. I'm one of the few that says, I want the highest rents possible. So the same properties that were sitting on the market back then are getting big discounts. This shift is exactly why understanding cap rates is so crucial. Let me give you an example. I made an offer last year. I was the highest bidder on a big property in Dallas, Texas. I offered $61 million for the property. Highest offer. I didn't get the deal because they went with somebody at $60 million who was a local buyer. But here's what's interesting. 2 years before, they were going to put it on the market for $70 million, decided not to put more money into it to increase the value. They did that and still only got $60 million from the new buyer. Now you might sit there and say, Paul, I'll never buy a $60 million property. Two things to that. One, don't ever say that. If you want to, you'll figure out a way and we'll help you get there. And two, okay, don't call it 60 million. Do me a favor. Take 2 zeros off. Great, it's 600,000 now. Great, take another zero off, it's 60,000. The numbers still apply the same way. I want you to think in terms of percentages. For a $10 million property at a 4% cap rate, compared to today at 6%, that same property has lost over $3 million in value. That property in Dallas lost well over $10 million because they went and put money into it to increase the rents and still didn't get it. Now, if that was confusing, I really encourage you to rewatch that. Cap rate, don't feel bad. Cap rates was the hardest thing for me to get, but the second I understood it, great. It was time to move on. This is always the hardest thing I teach when it comes to real estate. Just remember a few basics. One, cap rate is the cash return you make if you paid cash for the property. Two, as cap rates go up, prices go down. As cap rates go down, prices go up. So let's do that math here on that same example. $10 million property. It's a 4% cap rate. So that means the property makes $400,000 a year. 10 million times 4%. So the property makes $400,000 per year. Now, let's say the cap rate goes to 6%. So we take that 400,000 now, and instead of 4%, it is now 6%. So what's the math? That same property is now worth $6.7 million, a drop of 33%. Same exact property, just because interest rates changed that quickly. And interest rates did change this quickly back in 2022. Rates went up very quickly. Now, if you had a longer-term loan, where you sat there and had good covenants, which is bank covenants for the property, and you were able to raise rents along the way, you would be fine. So even though the property's income hasn't changed right then and there, a higher cap rate means a lower property value. For some owners, this meant steep losses they had to realize by selling the property fast. But for prepared investors and for investors who currently own property and make sure they're always raising rents, it allows them to snap up bargains and allows them to make their current properties even more powerful in these markets. So I want to clarify about the 2008 crisis. While today's situation does involve a lot of cap rate expansion because of interest rate increases, the 2008 crisis was a little bit different. Back then, banks simply stopped lending entirely because they made so many stupid mistakes. Just remember, guys, the same idiots who caused that same problem, a lot of people sit there and say, my banker would never do that to me. Really? They did it back then. They'll do it again. They didn't want these assets in their books. They viewed all real estate as toxic. This forced owners to either refinance, which was extremely hard, or pay off the mortgage in full. In fact, some of them even required you to pay it off in full, and they wouldn't even let you refinance. That was their option. Today, this is more about rising costs than a total liquidity freeze. That is a big difference. That's why I always tell people, I don't think today will end up being like back then. So, how do you find and profit from these distressed deals? Well, first off, focus on properties with value add potential. Look for properties where you can increase the rent. For example, a 20-unit building with rents 10% below market could offer very quick upside through modest renovations. Just remember one thing, guys. Whenever your neighbors are charging, you can probably go higher. Because one, you can out-renovate the crap out of them. And two, most of them are a bunch of bitches and they're not going to charge high enough rent. That's an absolute fact. I always love it when I hear people say, we look at the comps in the area. I'm like, well, if you want to be a loser like everybody else, go ahead. I look at the comps and then I add 10% or more because I know I can get a higher rent. Combine that with better management, you doing your own work and operational efficiencies, and you can significantly boost both your cash flow and value. Now, build strong relationships with brokers and lenders. Guys, I hate that word relationship. It's so overused and full of shit. At the end of the day, brokers and lenders are all whores. They want money. If you can close deals, they will work with you. You could literally take a dump on their faces during the meeting, and if that check clears, they will do work with you forever. They are whores. That's what makes them whores, doing things for money. That's exactly what's going on there. You just need to make sure that you position yourself properly, take action, and lock it down before somebody else does. To all the brokers and lenders out there watching right now who disagree with me, if you're at the table and you don't know who the sucker is, there's one person who's a sucker. That's you. And if you think I'm wrong, let's see what happens during the next crisis. I've seen it time and time again. Everyone bails and runs out of the room when things get tough. Just like the cocky salespeople at the Cleveland Cavs who thought they were the best salesmen in the world when LeBron was there round one. And the second LeBron left, they all bailed. And they all said to me, we're selling because of us, not because of LeBron. The second LeBron left, they all got new jobs. It's no different. Same with the bankers out there who all bailed in 2008 and weren't there for their clients when their clients were losing their asses. You have leverage, especially in a situation where a lender's in trouble. You have that leverage. Use that to negotiate better and favorable terms for you. But remember, make sure that you bring something to the table that makes them want to go with you. And make sure you can add real value to the property and always do your due diligence. But again, it's very, very important that you don't lose a great deal because you're trying to get a little bit better. If you typically want 15% IRR based on our real estate calculator, if you have a bunch of good deals that you usually do at 13 to 15%, maybe you go 18 to 20%. Don't try to hit grand slam home runs. Guys, just to let you know, I missed out on a lot of great deals because I kept trying to hit home runs from 2014 to 2020. I was always wanting to hit home runs. But you got to remember one thing. You can make a lot of money on 15% returns. You don't need 20%. Now you might sit there and say, well, Paul, I can make a lot of money on 10% returns. True, but there's more likely in real estate that 10% returns aren't enough. And if you can invest in the stock market and over a long period of time, get 9 or 10% return with very little work, I would do that. Guys, distress in the multifamily market isn't a sign of doom. It's an opportunity. Remember, downturns aren't the end of the road. They're where smart investors build wealth. So are you ready to turn market distress into your opportunity? I've done it myself. And with the right tools and the right community, you can too. Last year alone, using this tool, I bought over $30 million in real estate. And this year, I'm already in contract on $5 million and trying to buy a $25 million property as we speak. And it's only January 15th, and I use this tool right here for all of this. That's what's important. Join our exclusive community at everythingmoney.com, where you'll get access to real-time deal analysis, expert insights, and a network of top investors. Join a community of these top investors who are already seizing these opportunities. We have community chats in there specifically about real estate. It is a great community to be in. And with our real-time deal analysis, you won't just stay informed, you'll stay ahead. So sign up for our 7-day trial, $7 for 7 days. It gives you even more than the real estate. It gives you stocks, it gives community, it gives you everything here, and see how you can be ready to make your next big move. I'll see you inside.